In this video, I'm going to cover the Bull Call Backspread. And when I choose a strategy to use for options, one of the first things that I do is I kind of check my personal sentiment about the economy and the markets. And so I look at it short term, mid-term, long term. So short term, 0 to 3 months, mid-term, 3 to 11 months, and long term, 12 plus months. And currently, my short-term, mid-term outlook is that I'm 65% bullish and 35% bearish on the market and the economy, and I am 0% neutral. So I believe that and have strong conviction that things are either going to move up or they're going to move down violently. And so I am looking for strategies that kind of fit that mindset that I have. Now, long term, I'm 100% bearish, so I kind of factor that in also. So what strategies potentially do I typically look at? Well, one of the first ones is looking at cash. When things get really crazy, you may want to just sit it out and hold cash, and that's not necessarily a bad strategy. The second thing that I look at in this environment is something I covered in a previous video, which is called a long straddle, and it's basically where if things kind of stay where they're at, I stand to lose on that particular strategy. But if it goes if the market explodes and goes up or goes way down, I'm covered. Either way, it's a defined risk strategy and has unlimited profit on each side, whether it goes up or down. Obviously, it can only get down to zero, but I've got myself covered on that. Now, the Bull Call Backspread is one where I'm still directional, but it's almost like having one foot in the on land and one foot in the boat. I'm 65% confident that things are going to turn out and turn up, and I'm 35% bearish. So I want to kind of cover myself there, and so that's when I would use it. There's another one called a bear put backspread that I'll cover in a separate video. But that's kind of my mindset. So I look for certain stocks out there or ETFs that fit kind of where my thinking is, from a sentiment standpoint, and also from a technical analysis standpoint, it looks like it might be something that directionally is going to be moving up. And so let's go to Thinkorswim, which is the platform, one of the platforms that I use. I use multiple platforms, and look at an ETF called DIA, and it's currently trading about a 307.20-ish, as you can see in the upper right-hand corner here. And I'll look at its chart, and I can see, boy, it looks like maybe it's bottomed out. We've got a lot of gaps to fill here. And so it may not be a bad strategy, but I want to look at and see what the options that are available to me. And so in this particular option chain, let's just, for grins, we'll look at July 15th, and we'll look at a 285. And this is one of the things about a Bull Call Backspread is that you're going to buy one as a ratio, or really a ratio comes out as you're selling less option strikes than you're buying. So in this scenario, I'm looking at selling the 23.55. I'm looking at buying 2, and I just have to change this on here to 2 of the, not 32, 2, and you can see that I have a $5.62 credit for that exchange. So that way I don't have to outlay a bunch of money for this particular bull call spread. All right, so that's for July 15th. That's 30 days out, and it's basically saying, if I look at the profit scenario on this, it's got to get to 320, which is about $13 away in order to start realizing the profit. And if the stock reverses on me and I'm completely wrong directionally, which I've been known to do, then at 290 or so, if it gets less than that, then it's going to be about, I'll get my credit of $5.62 times the 100. That's one contract, $562 if things go against me. Now I can play with what my selling and buying and all that type of thing if I want to adjust those. But let's just go with this for right now. And you can see that as long as it doesn't stay right in the middle, that's going to be the worst case. I'm going to lose my total premium that I paid of about $1,400, both in selling and buying the two. It's to cover how much the whole 3 legs cost me. I can lose $1,400 as my defined risk, meaning I can't lose anything more than that. And if it continues to move down the scale, obviously you can start to see up here the profit. I lose less as I move towards my break even at around 320, and I get beyond 320, and then I start to really realize profits associated with it. So for a directional trade, I like the idea, and especially now with things volatile, and also with me being directionally challenged on ETFs and stocks and which way they're going to go, I like the backstop here. And like I said, I'm not neutral at all. So one of the sites that I go to take a look at my entire profit scenario is optionsprofitcalculator.com. Now, when you get there, you'll see this upper table, and you just go to ratio backspread, and I've gone ahead and filled this out. And in this particular case, when I ran it, the price was $307.15, and the price per option for buying my 2 calls was $12.45 at the time, and my price per selling the option for the August 19th is $26.55. Now, one of the things that I didn't cover, I want to go back to, is this difference between the pricing, because I ran it for July, and you're seeing in the option profit calculator for August. Now you'll notice the first thing is at 285 strike to buy that call is $25.65 if I go out another month, which is more. So I'm paying more for the further that I go out, obviously, as time goes out. There's a greater possibility of hitting the my profit, and so you're going to pay more premium for that. And so in this particular case, we'll just run it here real quick. We'll delete that. We'll go through the August 285. We're going to sell 1, buy 2 at the 205, and it's roughly, I think I had $1.65 on the option calculator. It's $1.32 on here, and you just kind of see what the ratios. I got to go out a little bit, $323 because it's more premium, and so that's what you're going to see in this options calculator. So what does the profit scenario look like? So you can see that if I early on, I could take it off. Let's say it rifled down. I was really directionally challenged, and it went down to 244. I still get $60 in the trade, and you can see the calendar up here if by, let's say, the end of the day it had, things tanked, and had gone, I could still begin to profit in the green here over time. And then as I go out, you can see that this comes more into play as you get closer to the expiration date in August. So those are, I like to look at this. It also gives me an idea of what the probability of profit is. It shows me that 52.3%, and shows my expiration or my break evens at the expiration, what those would be. But you can see there's a number of ways on each side here that I can benefit, with $165 being the most that I could make if things on one contract, if things really went against me. So that is the things that I like to see. Is just, it gives me a sense kind of where am I at, how much of I made or lost, or how much does it have to move in order to get to where it is. Now, for me, strategy wise, if it goes against me, I have a tendency to try to get out of the trade. So if I can make it for a little bit of profit, if it really dumps, I like to reevaluate at that point. If it does move my way, I will let it run, but I will also pull it 30 days out, because all of a sudden things could go against me. So I kind of take a look at it. I like to take profit, when things move in my favor, and then I can reopen it or look at it. But because of what I'll talk about in considerations for this strategy, because all options have their crap basically, and but as you get closer to expiration, you get theta decay, and it'll eat away at your profitability. So you always want to be looking to get out in these particular scenarios, and give yourself enough time. I mean, and again, we'll look at that in the considerations. So why don't I just get to that? Okay, so what considerations do you have to have for the bull call backspread? Well, the first thing is open interest is important to me, meaning that if I want to get out of it, I want to make sure that there's a lot of people trading that particular, what they call underlying, which is just the stock or the ETF or the futures if you trade in that. Gives me the ability to get out more easily. And other than looking up what the open interest is for a particular underlying, you kind of tell just by the bid and the ask. If there's a big spread between the bid and the ask price, that it's probably doesn't have a lot of open interest. If they're right together, the bid and the ask are together for the option, then that's going to be something that tells you that there's a lot of open interest in that particular underlying. So that's one thing. That the second thing is the volatility. Now, typically they'll tell you to trade the bull call option when volatility is low and rising, but what's low, and what's considered high, and different people will give you different numbers and rule of thumbs, if you will, for that. But right now we have pretty high volatility, right around 30, which does two things. One is it raises the premium that you're paying for this, so you really have to consider that. But when things are low volatile, they might be sitting there. I might not have the same sentiment that I have, but it could go up, and has moved up. And I placed some of these actually back when the volatility of the stocks were more in the 24, 25 range, and now it's gone up to 30. So it might go to 40, it might go to 50, who knows. So I'm looking at the volatility of not only the market, but for this particular stock or ETF in this case. And you know, when it's got, you know, high volatility, however you might define that. Some people define it as anything under 20 is low volatility. Anything from 20 to say 25 is, you know, middle of volatility. Anything over 25 plus, or, you know, is high volatility. And you just, you know, what are your settings for volatility? And again, typically you want to go low to high. The other thing is that the premiums are going to be more when you have high volatility on a particular underlying. The other thing is the time decay that I mentioned. You know, I'll put links to you know, things about time decay, but it's just that as you get closer to the expiration date, it eats away at your extrinsic value of you know, what you have. You're running out of time. You know, the shot clock is there, and so there's pressure to get out, and especially anything like a straddle or a backspread. As you get closer to the expiration date, they really decay quickly, and they call it theta decay also. But you know, the other thing is, when do I place the trade? So typically on days to expiration, I like to give them time to run. You do have people that do things with let's say someone has a quarterly reporting that they're doing on their stock. They're doing, you know, they're reporting their earnings, they're reporting their revenue, they're reporting their expectations, and once leading up to that, some people will play either a straddle or a strategy like this if they're expecting, you know, one way or the other to go, you know, right up to that moment. I don't play that game. I think the premiums get pretty high for that, and so I feel stuck when I've tried it. I like to give it time. I'm going to say at least 45 days, and typically most of mine are 60, 90, and even greater than 90 days out. It gives it time to kind of move as far as the market goes. And I'm paying a little bit more premium there for the spread, and that's why I have to evaluate each one and say, okay, this thing's got to move, you know, 10% before I get any profit out of it. And I may say, boy, that's a lot, and the premium's high, so I may not, you know, it plays a role in my decision making. You know, like I mentioned, the last consideration really is when it's profitable. I'll typically take it, especially if it moves the direction that I didn't expect it to. So in other words, in the case of the call backspread, I'll if things let's say move down 10%, and I'm, you know, in the money, so to speak. I've got profit on the bull call backspread, then I'll take the profit. And like I said, at that point, I'm probably reevaluating what I'm doing, because if it's not the strategy that's working out for me, then I'll probably be rethinking where my sentiment is, what underlying I picked, and a number of other things. So anyway, that's the bull call backspread. I think it's a decent option strategy. Whether you think it's a decent option strategy for now, you know, that's something that you either need to figure out if you're trading options yourself or with your financial advisor. I'm just sharing things that I do. So that's it for this particular episode, and I will be putting a bear put backspread video together after this one, and I'll put a link to it at the end, which you should be able to see up here in choices. So that's it for this episode, and remember, there's always a better way.